Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Now, the markets are kicking off 2026 amid a slew of conflicting headlines, a lot of cross-currents, and it's a year that could be filled with big shifts for ETF investors. So joining me now to break all of this down is Jay Jacobs, the U.S. head of equity ETFs over at BlackRock, alongside Todd Rosenbluth, the director of research over at VettaFi. Gentlemen, thank you both for being here, and Happy New Year.
Happy New Year. Great to be here.
It's good to be here with all of you guys as well and our audience. So let's talk a little bit about the ETF Edge, I guess, thematic investing playbook as we head towards the bulk of 2026. We're here now. It's our first trading day of this real new year, right? And we had, we traded on the second, but this is the first real full week of 2026 investing. So maybe, Jay, we'll start with you. You work at the biggest asset manager in the world, and you guys have a lot of different products out there. If I was to try to pin some of the big themes that you will be looking for in terms of ETF and thematic investing in 2026, what would they be for you? What would they look like?
Well, I think it really is about these three different categories. The first is really what are the biggest growth opportunities in the market today, where you have to get laser focused to try to find some of these more targeted exposures like artificial intelligence that could do very well in this environment. The second is, and maybe more relevant for retirees, is where are you going to get income from? We are in a falling interest rate environment. We expect some cuts this year. You need to find new sources of income to diversify your portfolio and generate, income from it. And the third, as we see these bouts of volatility and maybe unpredictable aspects of the market, where can you really get diversification for your portfolio? Something that's going to behave differently from stocks and bonds so you can have more ballast to, weather the storm of different volatility events.
Todd, this is interesting as well, because for the better part of, you could argue maybe the last 5 or 6 years, certainly since the pandemic, there has been a kind of press your bets and get rewarded type mentality, meaning the places that have really worked, and if you kept putting more money into those places, you've ridden a huge wave, and AI is probably just one of those stories, right? One of those places. At what point, though, why would investors want to get off of that train right now, and why would they want to look at things like diversification? If those places had been working so well for so long, what signs have you seen that they are not going to work as well as they have in the past few years?
So I guess a couple of things to that. One, I do think some of the themes that worked in 2025 are going to be relevant again in 2026. So AI is still going to be a popular theme to invest in for the overall marketplace. We've seen it for ETFs that are targeted and have AI in the name. Jay has and team have a fund that's BAI is the ticker. That's been very popular, or was very popular in 2025. We've seen some other products that are AI adjacent, nuclear energy, for example. The Range Renaissance Nuclear Energy ETF, NUKZ, was up 55% in 2025, and we think that those trends are likely to continue. But what we saw in December that was interesting to me is we started to see investors move into small cap ETFs. They were out of favor for much of 2025. They underperformed. Small caps is an area that could perhaps perform well in a lower rate environment, and so we've started to see small caps gain attention. Does that persist in 2026? We think it might. And if it does, then there's a range of different ETFs that are available.
It's an interesting point, Jay, because the idea of a broadening out trade has been talked about fairly for the last 10 years, and it hasn't really materialized. It really has been, for the most part, in a simplistic view, all about 2 or 3 key sectors and parts of the market, and you could argue maybe 7 to 10 of the biggest stocks in the market as well. If you look at the way things have shaped up over the last 10 years and why things may be different this time around, people are not necessarily getting out of, say, AI, tech, comm services, and consumer discretionary, but they're looking at other places in the market as well. Where exactly do you think that search leads them to?
Well, we actually brought out an entire suite around this concept, because if you look at the market and the level of concentration that you see today, you could say it's either a feature or a bug, but it's reaching historical levels of concentration. And so we've brought out different ETFs to really be able to break apart things like the S&P 500 or the NASDAQ 100 to really be able to play this concentration in the markets. Do you want to overweight some of the biggest mega cap tech names? Do you want to broaden it out and go equal weight across the S&P 100? This gives you a lot of different ways to kind of build a ETF portfolio and really try to manage or lean into that concentration risk. So we've seen a lot of flows into top T, which is the top 20 names in the S&P 500. We've also seen a lot of flows into OEF, which is an equal weight version of the top 100 names in the S&P. It's really about people kind of thinking about building a portfolio and how much concentration risk they want in that portfolio.
Just how much more complicated is it going to be, Todd, given the fact that there are so many ETF offerings out there and that you have to stay on top of the types of holdings each have, the types of maybe style drifts that could happen, the things that may over-concentrate you in certain areas but underexpose you in others? How much more active, so to speak, do ETF investors have to be, given the idea that many of these moving parts are now moving at a pace that we haven't seen over the course of the last 10 years?
So there's a few ways to think about that. One is, are you active on your own? Are you investing in an active ETF that where the stock picking is being done by the portfolio management team, whether that's BlackRock, whether that's T. Rowe Price, whether that's Capital Group? There are all these firms that have brought their best managers into that space. And even if they have a narrow parameters as to where their areas of focus are, that's going to shift month to month, potentially quarter to quarter, certainly. But even if you're on an index-based product, we just went through a rebalance period that typically happens in December, tied to the VettaFi products, tied to S&P index-based products. A number of strategies look different today as we are in early January than they did a month ago. For example, Victory Shares has a free cash flow ETF, VFlow. We at VettaFi are the index provider behind that. It added energy and healthcare companies as part of its rebalance. So that's a good thing in that it's following the rules of the rule book. But as an investor, that's a good thing that you want to see that it's changing, but you need to stay on top of it. You need to make sure that you understand what is inside your ETF, whether it's active, index-based, or even if it's market cap weighted, because the S&P 500 adds some companies from time to time.
The active element is something we've spoken about at length for at least the last year, maybe even two at this point, because the emergence and evolution of the number of actively managed exchange-traded funds in the marketplace has been powering much of the ticker growth, if you want to call it that, within the ETF universe. Many of the newest ones out there are more actively managed type products, right? So Jay, if that's the scenario, many of these active ETFs are ones that target the three buckets that you just mentioned at the top of the show. Many of those ones are giving specific tailored exposure to certain types of strategies and certain types of either products or industries or anything like that. If you look at the way that is set up, what exactly does that fit into like for those three buckets? Are we looking at active ETFs as the main driver or cornerstones of each of those three types of themes? Or are you still looking for an index-based option that then you build alpha around, given some of those actively managed functions?
Every portfolio is going to be different, but I think one of the reasons active is resonating in this environment is there's more volatility and there's more dispersion across different asset classes and frankly different sectors as well. So it gives the opportunity for active managers to generate alpha and to outperform. If you look over the last 10 years, the S&P 500 has delivered something like 13.5% annualized. But if you look going forwards, many people expect that to be lower. So if you're trying to get the same kind of returns you've been accustomed to, you might have to start getting some alpha from an active manager to help make up that difference. We certainly see it in the growth space. One of our fastest growing ETFs last year was BAI, or Actively Managed AI Fund. This is managed by Tony Kim. He's really looking for what are the leaders in artificial intelligence going forward. If you look at that income category, we've seen funds like Bali or BALQ, where you have a systematic active strategy, which is not only looking to harvest dividends from different dividend payers, but also write options overlays on top of it to generate more income. And then finally, if you look in that diversification bucket I mentioned, we have a multi-strat product, IALT, which is incorporating kind of many different alpha strategies into one ticker to generate alpha while providing diversification versus stocks and bonds.
Well, that's an interesting one as well, because if you take a look at a product like that, right, where you have placed your money in a manager or a team of managers' hands to diversify on their own, to give you at least a little respite, if you will, from having to manage all of that on your own, yes, that's going to be a big diversification tool, but is it something that investors are increasingly looking towards, this kind of outsourcing of that, if you will, Jay? This idea, right, that you can actually get some kind of a multi-strat return without having to do a lot of those components yourself.
That's right. I mean, we like to call it kind of an easy button for alternatives, which maybe is a little bit kind of conflicting. But the idea is that alternatives are a great concept for portfolios, that they can provide a measure of diversification. But often where you see investors get hung up is, what are the alternatives I should get exposure to? How do I know what to allocate to different alternatives? Should I be dynamic about it? Should I be static about my exposure to different alternatives? iAlt really wraps all of that decision-making into one ticker. That's why it's kind of the easy button. Whether you want to get kind of dynamic macro exposure, where you have a strategy that's looking to go across different countries or different macro asset classes, whether you're trying to get equity market neutral across individual securities to find relative value, or you're looking at something that's going to try to play different style premia in credit or equities. All of those are often individual decisions investors have to make, but with iAlt, it's all wrapped into one ETF, so you can just say, this is my diversified multi-strat alternative strategy in my portfolio.
We talked a lot over the course of the last decade in ETFs, Todd, about the notion of hedge fund-like strategies, right? We talk about things like factor-based momentum type models. We talk about things like maybe the use of options and futures, commodity trading advisor type strategies that are now embodied in ETF format. What kind of demand have you seen from your standpoint, kind of across the entire ETF landscape, about some of these products? I'm going to call them hedge fund-like. We're not really calling them that these days, but you kind of know what I'm saying, that they're not traditional strategies. They are certainly more alternatives-based, to Jay's point.
So it's not a huge category yet, but it's growing both in number of supply of products and in demand. So Calamos, for example, is a firm that's brought out an auto-callable suite of ETFs. The first one they brought out is CAIE, and it's gathered over $500 million in assets in a relatively short time period, offering income in an alternative format. And that's interesting. We've talked about private credit, and we've seen some of the firms bring direct exposure or indirect exposure to private credit to get exposure through the ETF wrapper. And then there's other just long short strategies that are available. Some of them have been around a while and haven't gathered assets. There's some firms that have brought some of their expertise into the ETF marketplace. And then I would consider, and maybe we'll get there, but I would consider Bitcoin and the demand for Bitcoin ETFs to be an alternative as well. And there's been very strong demand in direct Bitcoin exposure or using options to be able to enhance the income. Neos, for example, has a relatively new and popular product, BTCI, that's offering income and Bitcoin exposure in one strategy.
Now, the cryptocurrency side of things is something that has gained a lot more traction over the course of the last couple of years, especially because large-scale asset managers like BlackRock now have options to invest in equity-like formats in terms of ETFs, but using exposure for things like Bitcoin and Ethereum. BlackRock has IBIT, it has ETHA, right? Those are two of the big ones out there that track the two biggest cryptocurrencies. What exactly do you see as the future for crypto investing with ETF investors using those vehicles to gain their crypto exposure?
It's still so early. It's only been when's its anniversary? In a couple of days, 2 years since IBIT originally launched, and we've seen it raise tens of billions of dollars. But still, many investors have still just been starting their educational journey around what is Bitcoin, how might it fit in a portfolio. For many financial advisors, maybe they didn't have access to crypto before, or even weren't able to buy IBIT until it was approved on their platforms. We're starting to see a much more broader group of people that can and are interested in investing in this asset class. So we see this still being very early days for Bitcoin and Ethereum. It's a lot more about education, a lot more about how does this fit in a portfolio, how might it behave in different market environments, and how could it sit alongside stocks and bonds.
Now, Todd, the crypto story is not one that's new for crypto investors to the direct cryptocurrencies themselves, but the democratization, if you will, of the markets because of the ETF business and the ETF industry has allowed more access to these types of exposures for traders and investors who are not categorized as, say, crypto native. What exactly have you seen that suggests that this ETF, I guess, focused crypto type investing really has maybe longer term momentum?
So I think last year was a great example of there was volatility tied to Bitcoin. IBIT, we'll use that as the example, saw some price volatility. I think it finished down for the year and still had one of the best years in terms of asset gathering. So it shows that investors that are moving in to getting exposure to cryptocurrency through the ETF wrapper have some loyalty to the product, have confidence in the long-term trends. They're not necessarily moving in or moving out based on that volatility. So that to me makes it feel like an advisor or an investor is offering an allocation to cryptocurrency as an alternative, and then they're sticking with it. They're not necessarily selling out and looking for another alternative so quickly. So I would compliment BlackRock and their shareholders for staying relatively loyal given the volatility that we saw.
Okay, and because it is the first show of 2026, I'm going to close out our interview here with the same question for both of you guys. And I'm going to start with you, Todd. As an ETF industry watcher, what are you most excited about in seeing develop for ETF markets in 2026?
So I'm excited to see what happens with share classes of ETFs of mutual funds or mutual funds of ETFs. We got the first round of approvals from, I think it's 31 different firms now have the green light in 2026 to bring their products through a different wrapper to the marketplace. I don't know how many of them and how aggressive they're going to be in that, but that's something that I have my eye on. I'm going to be watching that. And we have the Exchange Conference coming up in a couple of months. I think by then we'll have a lot of people who have started their journey of bringing their strategies into the marketplace. So I'm excited to watch that.
Yeah, we'll see what the mile markers are once more people get involved as well. What excites you the most, Jay?
I'm glad I get to go second after Todd. I'm most excited about the growth of the liquid alts category in ETFs. As Todd mentioned, this is a smaller category today, but as we see volatility in the markets and as we see people really try to build out more holistic portfolios using ETFs, I think the liquid alts category is going to play a really important role in helping manage through these different bouts of volatility.
All right, liquid alts, share classes. Todd Rosenbluth, Jay, thank you so much for joining us here. We really appreciate it. Now, we've asked Todd to stick around for the ETF Edge podcast. You can catch that and all of our other content at etfedge.cnbc.com. Thanks for watching. Happy New Year. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.